Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. There's just an hour to go until the closing bell. Stocks edging higher here. It's after President Trump unveiled more tariff letters directed at U.S. trading partners. And while AI chip maker Nvidia, meanwhile, became the first company to ever touch a $4 trillion market cap. Let's welcome in now RBC Capital Markets Head of Derivative Strategy. That would be Amy Wu Silverman, along with Yahoo Finance's Washington correspondent Ben Werschkul. And let's got tech editor Dan Howley, who are all joining us throughout the show to break down the headlines. Ben, let's start with you. What is the latest out of D.C., Ben?
Yeah, so it's letters day. So we have 7 new letters today from President Trump to a variety of trading partners. He's promising more either later this afternoon or coming tomorrow morning. A big one that he said this afternoon was going to drop soon is Brazil. So that's a major trading partner. But what we have so far are threats of 20 to 30% tariffs on a range of countries from Algeria to Moldova that would take effect on August 1st. And this is on top of 14 letters on Monday. So we're up to 21 letters total. The biggest nation so far today is the Philippines. That's Trump threatened a 20% rate there. And that's about the 30th biggest trading partner for the US. So these are kind of lower level trading partners at this point. The bottom line for markets is that investors seem to be looking through a lot of these, and largely because of the fact that nothing's changing this week. This is again an August 1st deadline, and there's growing skepticism here in Washington, and I would imagine on Wall Street as well, that what we're going to see on August 1st is actually going to be the rates dictated here. There's going to be a lot of talk to come between now and then.
Here's a question, Ben. As Trump fires off these letters, do we know how our trading partners are receiving these letters, my friend? What's the reaction? What's the response? I mean, I know, all right, there goes the letter. On the other side, does the trading partner think, all right, is this encouraging dialogue? Is it encouraging negotiation?
That is sort of the public response, as I would put it. There's a lot of response to this is let's keep talking. We're going to keep talking. There's a kind of always a new trade team coming through Washington. In recent weeks, there's no sense of that letting up in the coming weeks between now and August 1st. I'd say privately and even semi-publicly, there is a growing exasperation amongst our trading partners here about exactly what more can be negotiated here. There's some countries in particular that have talked a lot to President Trump. Some were even here at this past weekend. I'm thinking of Japan and South Korea in particular, but then got hit with big rates. I was talking to one of Biden's former top trade officials, and her note was, what else can these countries give? These are countries that negotiated trade deals in recent years. They have low tariffs already. They have low barriers already. Yet the first thing Trump did Monday morning was offer them a 25% rate. So there's going to be a lot more talking for certain, but I do think there's kind of growing exasperation. One last note on that I think will kind of increase this exasperation side here is a comment Trump made this afternoon. He was asked about his formula for these new rates. These rates closely track what he announced in April that was based on trade deficits. And his quote was, it was a formula, quote, based on common sense, deficits, based on how we've been treated over the years, and based on raw numbers. So the deficits piece is clearly the most important part of this. That's what the April rates were 100% based on. But I think it's going to be hard for these countries to figure out how they negotiate against what Trump considers to be common sense.
Amy, I want to get you in here as well. So as Ben noted there, so Trump's firing off these letters, Amy. The markets seem to be kind of shrugging this off. I mean, I have green across my screen here.
You're absolutely right. And when we look at the VIX and we look at that kind of psychological sub 20 level, very low realized volatility, I think essentially what investors are pricing is definitely that look through. And also the idea that the taco trade is in full force. We're very, very different now from where we were in terms of paradigm during April 2nd. And I think this just becomes another hurdle where investors are like, look, been there, done that. We know what happens. They're going to be looking for tangible dates, which arguably continue to get pushed out. And if that is true, then it's very hard for volatility to hang its hat on anything.
All right, just don't mention the taco trade in Trump's presence. He does not
keep that in mind.
He does not seem to take well to that. Meanwhile, so Trump and tariffs, that's one headline. Here's the other big one, and thankfully we have Dan Howley here to break it down for us. That was Nvidia briefly touching that $4 trillion market cap. What is the latest, my friend, and where does it go from here?
Yeah, I mean, obviously, this is a huge swing from what we saw in January, where we saw Nvidia lose that $600 billion, in market cap, as a result of the kind of revelations that we saw from DeepSeek, that Chinese AI company. The idea was, look, they managed to train their AI models, which they said were kind of up to snuff with the likes of OpenAI's models, on less than top-of-the-line chips. There was a whole kind of meltdown on Wall Street, people basically freaking out, saying, well, why do we need to think about Nvidia then? Then kind of the thinking started to change into, okay, well, they may have trained this on a less than top-of-the-line. There's been more skepticism coming into that and questioning whether that's true. But it's come out now that it's better to have a high-end chip to kind of run those models. So even if, say, they were developed using less than top-of-the-line chips, the top-of-the-line chips make them better, and so naturally that means that people are going to go for those top-of-the-line chips, i.e. Nvidia. So we've seen that kind of swing. There's the talk of sovereign AI, where countries are looking to get their own AI chips. We saw that in Saudi Arabia, in Europe, where Jensen Huang had been. And then there's the talk of the kind of China equation being taken out of Nvidia's own earnings. So they obviously took that $4.5 billion hit in their most recent quarter based on products that they weren't able to sell anymore through bans. They're expected to take an $8 billion hit in this quarter, but Wall Street is basically saying, okay, but that means that China's no longer in the equation. There's no more guessing as to, are we still going to see revenue? Are we not going to see revenue? If we do see revenue, is it going to be small? Now it's just the revenue that they know they're going to get, and so it puts them on more solid footing to make those projections. So it seems as though Wall Street appreciates that much more, and then obviously the coming Blackwell Ultra chip that's just down the line.
So Dan, since I have you, I'm going to switch gears hard on you. I just want your thoughts on this other headline that crossed, which is that OpenAI browser launch could be coming, Dan. That's per Reuters. Just curious to get your thoughts on that, Dan. I mean, of course, a lot of investors are immediately going to think what that could mean for Google. We should point out Google, tacking on about 1.3% here.
Yeah, I would hate to be Google. That's basically what I think of that, right? There's constant conversation now as to whether or not OpenAI is pulling users away from Google. Are people starting to use these apps more than Google? Chrome stands as that gateway for people to start using Google right away. That's where you search. That's where a lot of people start their internet kind of experience or journey if they're not going into an app or something along those lines. Now, if we start to see OpenAI come up with their own browser, well, they're going to be in ChatGPT immediately. And it's worth pointing out that Perplexity has its own browser as well. They talked about that today. So we're starting to see more of these AI companies really push into Google's space, just as Google starts to struggle with the kind of search aspect of their business. Don't forget, though, they do have their own Gemini AI that they're hoping can kind of supplant the search in the long run.
Yeah, I get the excitement around that headline. I would want to see, though, how that OpenAI browser, how it actually performs. I will wait for the Dan Howley review of that, though, for me. Thank you, Ben and Dan. Thank you both. Well, for more on what's next for Nvidia after starting the $4 trillion market cap club, let's welcome in now Matt Bryson, Wedbush Securities Managing Director, Equity Research. Matt, it's always good to see you and to have you on the show. Start right there. What a big milestone for Nvidia, for Jensen Huang. Matt, you know this company so well. I'm just curious to get your top line thoughts.
Yeah, I mean, things have gotten better for them over the last 4 months, right? We just heard, DeepSeek was a concern in January. What we actually saw was China investment in AI picked up over the next few months, at least until they were prevented from buying the Nvidia chips. Back in January, people were concerned about Blackwell. The products weren't fully baked. That got taken care of. It's picked up over the last 3 months. I just came back from Asia, and everything sounds really strong in terms of supply chain is trying to keep up with demand, and right now they can't. So there's more room for Nvidia to sell Blackwell, whether it's Blackwell or Blackwell Ultra, over the next few quarters. And then we get into next year and you have all these big sovereign players, they come and spend, and that's just in addition to the cloud. So arguably Nvidia has more visibility than it ever did into market growth. And so there's just a lot of good things happening for Nvidia.
Is there any sign, Matt, that you've seen that big tech, which of course that's Jensen Huang's big customers, that they are slowing down at all their AI spend?
Not in the near term, right? So at least what I'm hearing again is that Nvidia and TSM just can't get enough Blackwell chips out to satiate the market at this point. And again, it's always been a question about what happens next year. Can cloud spending lift again? But talking about Nvidia being de-risked, well, now that you have all this sovereign spend that gets added to the cloud, if cloud spend doesn't go up as much next year, it just matters less.
Matt, I also want to get your take on this FT headline that dropped this afternoon. Nvidia, they say, plans to launch a new AI chip designed specifically for China. They say as soon as September. So this would be, I guess, a chip that would be compliant with U.S. export controls. How should investors be thinking through a headline like that, Matt?
Yeah, Josh, we've heard that a couple of times over the last few months. There might be another Nvidia chip. The question is kind of what the total demand is going to be. So you got to assume that it's going to be less capable than what they were shipping previously. What they were shipping previously, the capabilities were already reduced. And so it comes down to it's all additive to what there is now, but it's probably not an 8 billion revenue adder. It's hard to say, is the market 4 billion per quarter? Is it 2 billion per quarter for this less capable chip? I don't know. But again, at this point, with China basically taken out of the equation, whatever they get is additive.
What are the risks, Matt, that you think investors here need to think about? Would it be valuation? Would it be competition? What would be on the wall of potential worry, Matt?
Yeah, Josh. So I think it's thinking a few years out, maybe. But it's once you get past 2026, and again, we've got all the sovereign spend coming in, and so you just have this big buffer for Nvidia, I think, in the next year. But where are the killer applications, right? We haven't seen them yet. But could it be OpenAI's new browser? Could it be whatever device is coming out of IO, so the Johnny Ive startup that OpenAI just bought? And in my mind, these things will happen. It's just a question of timing. And I know people have thrown out the Cisco paradigm of 1996 is the big concern for Nvidia, right? There was all that spend, and things were overbuilt. But remember, between 1995 and 2000, when Cisco kind of started to fall off, there were huge productivity gains. And I would say we will see those productivity gains. We haven't yet. And until we see those productivity gains, I think there's just room for more spending around AI.
Matt, always good to see you and to have you on the show. Thank you, sir. Well, for more on all the latest market moves now, let's welcome in here Ryan Dietrich, Carson Group Chief Market Strategist. Ryan, great to see you, especially on set.
Yeah, it's fun to do this in person from your fine city, New York. Thank you for having me.
Great to have you as always, sir. Let's pick up right there on this discussion about Nvidia. What a milestone for that company. What a milestone for Jensen Huang. You saw that headline drop. What do you make of it?
I think it's a good reminder for investors. What we think about it in February, right? Mm-hmm. DeepSeek came out. I don't know exactly how much Nvidia was down, but it was crushed, right? Yep. And now here we are back to making all-time highs. I mean, we are in a bull market. This is a global bull market. Things get beat up a little bit. I've jokingly called this the Rocky Balboa market because the day after a down day, you tend to bounce back really strongly this year. And that stock just encapsulates, really shows that. But at the same time, I guess I'm not too surprised because that's a leader and this is a bull market.
I wouldn't be surprised, Ryan, if some investors, they see when a company hits a milestone like that, maybe they think, all right, well, that's it. I missed my chance. I missed my opportunity. Best days behind it. Is that the right way to think about it as an investor?
I'd say no, because I think we've heard that at $1 trillion, $2 trillion, $3 trillion. So here we are at 4. So I'm not saying, I do think it'll probably keep going up because we're in a bull market, like I said there. But those round numbers, you can see some of that with the Dow 40,000. You sometimes see a little bit of that. But when it comes to these big market caps, I'll tell you, let's see about earnings. I know they report at the end of earnings season, but I'll tell you, death, taxes, and Nvidia beats on earnings. I joke, those are the 3 things you can always count on in life. We'll see, but it's been that way, obviously, for the last, going on 2.5, 3 years, and they have earnings.
Amy, I want to bring you in as well. What's your take on Nvidia hitting that milestone?
I mean, I think it matters in the sense that we've had so much concentration risk, Josh, and this only builds it even more. I speak to a lot of institutional investors, and their biggest fear hasn't been downside, it's been missing that chase. And here we are again. And I think, certainly you could call that a bull market, you could call it exuberance, you could call it a froth. It doesn't really matter what you call it, but when people have to jump in the pool, we see that quickly in options, and that's continued to happen in Nvidia, and I wouldn't be surprised if it keeps going from here too.
A broader question, Ryan, while I have you, since I know you study history so well, history buff that you are. What does history tell us about the second half, given the first half we've just had?
Well, I call it the sweet spot. Like you play golf, hit the ball, the sweet spot. When you're up between 5 and 10%, like we were this year, so not up a whole bunch or not down a whole bunch, just nice and solid. The rest of the year for the S&P has been higher 13 out of 15 times.
That sounds pretty good, Ryan.
Pretty good. Then you lay on one more when you're higher in May and June, like we just were. Usually those months aren't that great, so it's kind of rare to be higher. The rest of the year this time is higher 15 out of 16 times. These are just two stats. But when you look at these things, I'm an old school message of the markets, disciple. What's the market telling us? I've come on with you for a while, saying the market is telling us it wants to go higher. And add what Amy just said there. Looking at sentiment, I mean, there's some froth, I'll admit. But what we're looking at, a lot of hedge funds have missed this. A lot of institutions. Look at that global fund manager survey, Bank of America. I mean, wildly underweight U.S. stocks. So you can kind of pick and choose there, but I'm not seeing froth that worries me significantly here, Josh. I still think it's a bull market, and I think this summer surprise rally will continue. One more. July's been higher 10 years in a row. My math is right. This year could be 11 if we're higher, tie the all-time record. I think there's a good chance that happens. And then as we get into the fall, maybe get that indigestion, whatever the worries are going to be. But there's a broad-based rally happening, and we need to listen to what the market's telling us.
All right, listen to what the market tells you. Things are looking good, Ryan says. What if, my friend, you do take a stumble here? Let's say there's a pullback, there's a correction. How do you think investors would respond and react to that? Do you think they move right back in, they buy that dip?
Well, we've seen that from retail crowd. I mean, retail has, we had the 10.5% drop in 2 days on Liberation Day, and what did we see? I mean, honestly, the retail crowd were the ones that got back in. Fortunately, the smart money and the big money, they've kind of been a little 1 foot in, 1 foot out. So I think they will. At the same time, dollar cost averaging, I think a lot of investors have learned. We've seen these big pullbacks and scary times before. Every year, scary headlines. I mean, I came here last August. You and I were doing this last August. What were we worried about then?
Sir.
The yen carry trade unwind. And that was a really scary deal, really big drop. Now it's like, oh, that's right, the yen carry trade unwinds. I'm not minimizing tariffs or whatever the next worry is, but earnings are hitting all-time highs. Profit margins are new highs this cycle. Yeah, there's some froth out there, and maybe some parts of the market are a little pricey. But honestly, it still looks pretty good.
Let me ask you, Amy, if we took a tumble like that, you think investors move right in, they buy that dip?
It's interesting because I was thinking about August 5th, the Volmageddon, whatever you want to call it, with the VIX spiking to 60, and that would have been a good time to get back in, right? It's these volatility potholes that come when there's a lot of liquidity that's left the market, which typically is August. So July is a good return year. July is a low VIX time, but then August is one where you actually do see VIX kind of go up 15% usually, because there's some sort of low liquidity stumble that we get. It could be yen unwind, it could be anything. Those typically are times if you were missing out on that chase and you do need to jump into that pool, those are typically good times to do it.
Ryan, I get you out on this. So when you're talking to clients and they say, all right, Ryan, things look good, you're constructive. What's the wall of potential, or what are the risks I need to have on my radar?
Well, clearly tariffs in one tweet. We know that. But I'll tell you a little step further, potentially a Fed policy mistake. We're in the camp that the Fed should have been cutting earlier this year. Yes, Powell has said we're not going to cut because of tariffs.
You agree with Trump. It's too late, Powell. That's what you're saying.
I'm not going that far, but we do think he should be cutting already. I think he said 300 basis points in cuts. No, we're not saying that much, Josh. But the reality is, what if they should be cutting? Let's be honest, he was a little late hiking. I think he's a little late cutting, so that's one potential little pothole that's out there. There's still time, but I do want to say one thing at the end. I know your dad watches. Your dad said he liked me, so hi, Mr. Lipton. Just
Big Ryan guy.
Give a shout out to your dad.
Guarantee I get a text from Andrew right after this.
That's good there. But again, thanks for having me as always. Love your city, and I'm going to have some good steak tonight, so I can't wait to go out. Yeah, thank you.
Ryan, it was great to see you, especially on set. Yeah. Thank you, sir.
Absolutely.
We are just getting started here on Market Domination. Coming up, Yahoo Finance's Fed correspondent Jennifer Schonberger sat down with U.S. Deputy Treasury Secretary, that would be Michael Faulkner. That interview and much more when Market Domination returns. With President Trump sending out new tariff guidance letters to 21 countries, a new deadline of August 1st for reciprocal tariffs to go into effect, there's a lot to watch out for in Washington, which is where we go now. Yahoo Finance's Fed correspondent Jennifer Schonberger did sit down with U.S. Deputy Treasury Secretary Michael Faulkner.
Let me start with why the president focused so much on trade early on in the administration. And that is because for decades, we have had leaders in this country that have been willing to ship a lot of our industrial base abroad. And the president recognizes that you cannot be a leading global power if you do not manufacture domestically. So it is not just about jobs, it is also, which is important because manufacturing jobs are an incredibly important source of wealth creation and economic mobility for American workers. But also from a national security standpoint, we have to be able to make things here. And so that if there were any kind of geopolitical problem, we have industrial capacity to fill our needs. And so the president committed that we were going to finally address the trade imbalances that, as the secretary has said, have become the largest he has ever seen, to the point that if we do not get them fixed, it is the global economy was on an unsustainable path. So that has been the objective all along. And the president took bold action back in April on Liberation Day and gave the nations around the world an opportunity to come and negotiate with us to address long-standing tariff and non-tariff barriers. So it's not just the tax that they apply to products and services that come in from the United States, but it's also the restrictions they put on business activities, what we call non-tariff barriers. And I think what you've seen is there are a set of countries who have come in and been serious about negotiations with the United States government, the U.S. Trade Representative, Commerce, and Treasury, and those are continuing to occur. You've then seen other countries that have not been as forthcoming or not as willing to address some of these longstanding issues, for which the president is sending them letters. So I think it's not per se that he's frustrated with the process overall, but for countries who I think heretofore have not been serious about addressing some of these longstanding issues, the president has sent them letters notifying them of the outcome.
So it sounds like we could still see a combination of deals and letters.
That's right. There are still negotiations for those countries that are still engaging in good faith negotiations. There are still opportunities to strike deals.
The Federal Reserve is closely watching these trade negotiations and the impact that tariffs could have on inflation. So far this year, inflation has remained benign, and the Council of Economic Advisors is out with a brand new report that shows that there has been zero inflation so far from tariffs, and prices have actually dropped. We looked at PCE back in May, and we did see that. What would you say to the Fed about waiting to cut rates?
So what I would say, first of all, is that inflation is at the lowest level that it's been at in 4 years. And if you look at our interest rate environment compared to other places around the world, there seems to be cause for bringing interest rates down. Now, again, I want to be careful because, at Treasury, we stay in our more fiscal policy lane, and the Federal Reserve conducts monetary policy. But I think one is hard pressed to look at the data and come to the conclusion that we are in an environment where inflation is a significant challenge to the economy. I think the economy would be much better served by reevaluating the current policy determination of where interest rates are currently at, given the fact that, as you said, we have strong evidence in the data that we are not seeing inflation. To the extent that we see it, it's primarily been in housing, and we know that housing inflation occurs with a lag. So I think that the economy would be well served by the Fed taking another look and identifying whether it truly is currently in the right spot on interest rates.
Well, speaking of the Federal Reserve, the president called again on Fed Chair Jay Powell to resign immediately during the cabinet meeting on Tuesday, and then turned to Treasury Secretary Scott Bessent and said, "I like you better." At the same time, we saw a report out this morning that the current chair of the Council of Economic Advisors, Kevin Hassett, looks to be one of the favorites as well, Bessent on the short list. Has the interview process started for the next Federal Reserve chair? And what can you tell us about who is most favored right now?
So what I would say is that the president talks to people all the time. So rather than saying that there's a formal interviewing process, just as he did when he was filling out his cabinet, which we have, the reason that this administration has been able to accomplish so much is because of the extraordinary talent that the president has selected to be part of his cabinet. And so He is constantly getting ideas from people. And as we saw, he cast a wide net. He talked to a lot of people, and he is going to, I presume, do the very same thing when he is picking the next Fed chair. He is going to cast a wide net. He's going to talk to a lot of people, and he is going to pick, I know, a fantastic new Fed chairman. Beyond that, I can't say that I've seen a short list or know who exactly is on that list, but based upon how well the president has selected people to serve in his second administration, I have no doubt that he will find us a fantastic next Fed chair.
And does the administration want Fed Chair Powell to step down from the Fed Board of Governors after his term is up as chairman in May of 2026?
It has traditionally been the case that when a Fed chairman term ends and they're no longer going to be chairman, that they don't stay on the Board of Governors. I presume, I would hope that Chairman Powell follows tradition along those lines.
The big beautiful bill, now law, signed on July 4th. How many jobs could we see created from this bill, and how much could it boost GDP?
Right. So the law that the president signed last Friday is the core of the economic program for the administration. Critically important that we extend the 2017 Tax Cuts and Jobs Act, as well as implement a number of new pro-growth tax initiatives. So no tax on tips, no tax on Social Security, no tax on overtime, the immediate expensing of capital equipment purchases, the immediate expensing of factory construction, the R&D tax credits. All of these are going to be boosts to growth. But most importantly was making sure that we didn't have a $4.5 trillion tax increase go into effect in December, which is what would have happened had this legislation not been signed by the president. So the most important thing, and as a result of that, we are going to, as well as with the trade activity that we were discussing earlier, as well as the deregulatory agenda of the administration, we are creating an environment where capital around the world wants to come into the United States and be put to productive use. So we are going to see enormous job opportunities for the American people as a result of all of this investment that's going to be taking place, because we are fixing and extending the tax system here in the United States. So there's enormous potential for there to be both significant increases in employment opportunities as well as job opportunities. Because again, when we're building construction jobs, when we're creating manufacturing jobs, when we are identifying new avenues of investment in the private economy, that is where productivity improvements come from. It is not from government, it comes from growth in the private sector. And so by unleashing capital in the private sector, by improving productivity, we are going to see the opportunity for enormous wage gains for the American people. This is not just theoretical. We saw it in the first term, right? If you go back to the results following enactment of the 2017 Tax Cuts and Jobs Act, you saw the lowest unemployment rate in 50 years. You saw wage gains for line and production workers exceeding those for supervisory workers. You saw the lowest poverty rates on record across all demographies. So by providing certainty, by providing permanence to those tax components that we put in place back in 2017, we are going to maintain and extend the economic record that served the American people so well in the first Trump term, and as the president said, unleash a golden age.
To your point on wage growth for blue-collar workers is the highest in 60 years. You pointed to we're going to have 100% expensing for factories, capital plant, and equipment, which will be permanent. So what kind of upward wage growth could we see, not just for blue-collar workers, but for Americans overall?
Right. So we have already seen that the first 5 months of this administration have seen the highest increase in real wages for the first 5 months of any presidency. And that's because there's already, in anticipation of this tax package coming together and recognizing the deregulation that's taking place, there has already been investment being made in additional workers and retaining talented Americans in the workforce. And so we are anticipating that we're going to continue that stretch of strong real wage growth. And so what I mean by that is wage increases well in excess of inflation. So as much as the Biden administration liked to talk about how much wages went up during their term, it's because inflation was so high and inflation overwhelmed the wage gain increases. So what we want to do is we want to make sure that every year, every month when people are getting paid, that their money is going farther than it did earlier. We want to see that their purchasing power improves because inflation is low and wage growth is high. And those are exactly the conditions that are going to be created by full implementation of the president's economic agenda.
And really quick, Mr. Deputy Secretary, before I let you go, there were concerns within the Republican Party about driving up the deficit with this bill. I know that the administration has sent a rescissions package to the tune of $10 billion past the House, on the floor in the Senate next week. Can we see more spending cutting plans being sent from the administration?
Absolutely. So as a result of the work that we are doing to identify waste and abuse in the federal government, the One Big Beautiful Bill had $1.6 trillion in mandatory spending reductions. Now, you may know that when on the discretionary spending side, it's a different process. We can't do that through reconciliation, so we do it through a rescissions package. That first package sent up from the administration is awaiting Senate action. Provided that the Senate goes forward with that, there are more rescission packages that can potentially come, because from day one, the president has charged every cabinet department and agency to identify places where we can be more effective with taxpayer dollars. And so, for instance, by finally completing the IRS modernization, it will just cost us less money to oversee implementation of the tax code. By improving our systems, by utilizing advanced technologies similar to what the American people realize in their private financial services, we can, at a fraction of the cost, engage in implementation and collection in the tax code with fewer workers. And that means that the request for money, the amount of money that it's going to cost us to operate the IRS, will go down. But the IRS is just one of many agencies where the president's efforts and the team that he has created have identified spending cuts. And so the way that we enact those is we go back to Congress with a rescissions package. There are more where the current rescissions package come from.
President Trump posting new tariff letters on social media to countries including Iraq, Libya, and the Philippines. For more on what it means for the markets, we're bringing in now Matthew Lazzetti, Chief U.S. Economist at Deutsche Bank. Matt, great to see you, especially on set. So let's start there, Matt. So President Trump firing off more of these letters, Matt. If you look at the markets, they seem to be shrugging this off. There's green everywhere today. But I'm curious how you're thinking through that, through the lens of an economist.
Yeah, I think in part the market response makes sense. Mm-hmm. We've had a lot of these announcements over the past several months. But the Trump administration, I kind of pointed out, has been on a de-escalation path relative to where we were on April 2nd. We have a few weeks until they kick in on August 1st. Mm-hmm. I think it gives a lot of leeway and runway for negotiations to take place to potentially roll back those tariffs. And so I think really until it becomes evident that those tariffs are going to be put into place, it makes sense for the market to kind of shrug their shoulders at the moment.
We did get Fed minutes, Matt, today, and it was interesting. There seems to be some debate there about tariff inflation. So when do you tell clients you think that tariff inflation starts showing up in the numbers? Because the prints we've been getting have been broadly benign.
Yeah, so I have a little bit of a different view on the inflation data that we've seen so far. Mm-hmm. So if you look at core PC inflation, mm-hmm. which is what the Fed focuses on, it's up 2.7% year over year today. It was up 2.7% year over year a year ago. Mm-hmm. 70 basis points above the Fed's target. We've had no progress over the past year. Mm-hmm. If you look at core goods inflation, household durables, recreational goods, it's actually up 2.8% annualized over the first 5 months of the mm-hmm. year. This is where you would expect to see the tariff effects. Mm-hmm. That's essentially the highest level that we've seen since the mid-1990s, mm-hmm. if you kind of strip out what happened during the pandemic. So I think you have seen the tariff effects in particular items, mm-hmm. but over the past few months, that has been swamped by other things. Airfares have been particularly weak. Mm-hmm. Rent and owner's equivalent rent have been soft as well. As we look ahead, I think you're going to have some pickup in some of these other categories that is also going along with tariff-driven inflation effects. And we would expect the next few inflation prints to be hotter.
Are there offsets, though, Matt, you would see from lower energy costs?
So I think in the past, and backward-looking, that happened. Yeah. As in June, we had a big spike in oil prices. Yep. Gas prices picked up on the back of that. And so forward-looking, it's less obvious that you're going to have offsets from the energy sector.
When the tariff inflation comes, if it becomes more pronounced, do you see it as more one-time, Matt? Is it persistent?
So I would expect, everything else equal, it is a one-time effect. The issue is that it's getting rolled out over time. So we had tariffs that began in January, then tariffs announced in August, now perhaps tariffs that are being announced in April, and now perhaps in August. That is going to be a rolling effect on the inflation data. That makes it really hard to disentangle in real time the effects. Moreover, if you look at things like steel and aluminum tariffs, that will lift car prices, that will lift car insurance inflation with some lag. It lifts auto repair inflation with a lag as well. And so I think what we find is that, yes, in theory, it is a one-time price level shock, but actually identifying it in real time is really, really difficult.
Who's going to eat those tariff costs, Matt? Is it consumers, producers, sellers, some combination?
So I think that's the big uncertainty here, right? And I think that the bottom line is that it will be some combination. You will see import prices probably will fall a little bit as foreign producers eat some of that. I think domestic producers will eat some of that as well, so margins will decline. But we do anticipate that some of it will be passed on to consumers as well. Our baseline assumption is that about 50% of the tariffs get passed on to consumers. That's in line with what you saw in 2018 and 2019. It's in line with what you've seen from surveys from the New York Fed. They went and asked businesses in the region how much of the tariffs are going to pass on to consumers. It was 50% on average. So we do think those tariff effects are to come, and we think about half of it is going to be passed on to consumers.
When your clients ask you, Matt, finally, how many times, Matt, you think the Fed's going to cut this year? What do you tell them?
So we've been kind of more hawkish on the Fed outlook. We expect that the Fed cuts once this year in December, and then 75 basis points in total through next March. I think near term, we're a little bit more hawkish than the market pricing. Through next March, we're exactly in line with the market. I think it's certainly about inflation and some risks about higher inflation as we look ahead. At the same time, if you look at the labor market, we've been waiting for the weakening and softening to happen. But honestly, if you look at last week's jobs report, the unemployment rate fell to 4.1%. We added 147,000 jobs, 150,000 jobs on average over the past several months. And so far at least, the clear negative effects on the labor market are not there.
Amy, I'm just curious, when you looking ahead for possible Fed cuts, what do you see?
It's interesting. There's obviously a lot of cross currents, but one thing that has been consistent in the derivatives market, even through Liberation Day and after the rally, is term structure has been very steep. And that's essentially the options market way of saying we're kind of worried about the future, and I'm calling this kind of the September through December bucket has been quite elevated, even normalized for the fact that the future is less certain than the near future, right? We don't know what we're going to do 6 months from now. Maybe we know what we're going to do this weekend. So even with that dynamic in play, it's been very elevated, and it's essentially, I think, pricing two things. One, when is that big inflection going to happen? I think the investors have been thinking of it as a switch, and it's not a switch, right? It's this rolling idea that you've been talking about, and that's why it gets lumped into this large bucket. And the second aspect of that is if the Fed does come into play, and also the fact that we've just had this tax bill, do these cross currents in any way cancel themselves out? The market doesn't know how to price that magnitude. It only knows that that's going to cause larger amounts of volatility, which is what we're seeing in term structure.
Matt, Amy mentions the tax bill. How stimulative is that for the economy?
I think at most it's a few tenths over the next year. In part, a lot of that is just extension of existing tax breaks that were in place. And so that's kind of status quo for a lot of households. You do have tax cuts on top of that, no tax on tips, no tax on overtime hours, some of the business tax provisions that were just mentioned. So on the margin, it's stimulative. And I think if you think about this from the Fed's perspective, inflation is above their target. There are upside inflation risks as we look ahead. The unemployment rate's at 4.1%. The equity market's at all-time highs and financial conditions are easy. And fiscal policy is somewhat stimulative. I guess as I put all that together, I don't think there's much urgency for the Fed to cut rates at the moment.
Matt, great to see you, especially on set. Thank you, sir.
Thank you.
Coming up, what kind of issues could German automakers face amid Trump's tariffs? We're going to break down the impact on the other side. Stick around, much more market domination that's still to come. German automakers may be feeling the pressure from President Trump's auto tariffs. For more, we'll bring in now Yahoo Finance senior autos reporter, Praz Sumranian. Praz.
Yeah, so luxury brands like Mercedes and Porsche are getting squeezed here, right, by the 25% sector tariffs on their cars. So we saw some results coming in for Q2. Mercedes global sales down 9%, but U.S. sales down 12%. Porsche sales also down globally, but they're higher in the U.S., but there's a little caveat. They're basically saying that they have to rely upon pre-tariff inventory that they already brought in that helped boost sales, as well as the fact that they ate some of the tariff costs with protecting pricing. So that's kind of a problem. And I spoke to Mercedes too. I asked them about what are you guys going to do for going the rest of the year. They said, quote, "We recognize the importance of consistency and transparency for our customers, committed to maintaining current model year 2025 pricing until further notice," meaning they're going to freeze prices for now. And for you, if you order a new car for a 2025 model new car, we continue to monitor the situation closely, are evaluating all options. will adjust to changing market conditions and the competitive landscape. So what they're saying is that they can't do this forever, right? They can't price protect forever, and it seems like model year 2026, we'll see some changes from pricing point of view. Look, they need a deal. They need a deal like the UK has with the US right now. 10% is what they have. That'd be great compared to 25, but it's not perfect either.
Who's in the worst spot, Pras? Porsche, Mercedes?
So with Mercedes, at least they have a factory in Tuscaloosa, Alabama, where they make a lot of their SUVs and a lot of their EVs. Porsche makes everything in Germany, and I think another plant in Slovenia. That's it. They're known for German engineering and kind of European handling and things like that. So to make cars in, let's say, Indiana, it isn't really on brand. So they're kind of in a tight spot there. BMW, which hasn't released their full data yet, big plant in South Carolina where they build all their SUVs, where they actually ship them out to other parts of the world.
All right, Pras, thank you, buddy. Appreciate it. Coming up, we are taking a look at the best ways to be positioned within the small caps in our investor playbook. Stick around, much more market domination still to come. Large and mega cap stocks dominating headlines and portfolios alike, but small caps lagging behind. Our next guest, though, says small caps will have their day in the sun. We're navigating how to play small caps with the Yahoo Finance playbook. Joining me now is Sandy Villery, portfolio manager at Villery & Company. Sandy, always good to see you. So you say here, Sandy, small caps, they're going to have their day in the sun, better days ahead. How come, Sandy? Walk us through it.
Yeah, and I believe in reversion to the mean. And over the very long run, you take more risk in small cap and you should get more reward. But over the last 10 years, large caps outperformed by about 5% annually. And even this year, S&P's up about 6 and small's only up about 1. I just think that from a valuation standpoint, the small caps are about a 23% discount to large cap. And when you look at the top 10 stocks in the S&P 500, they're trading about 29.3 times. The other 490 stocks are trading about 20 times. So we think they will have their day in the sun. And another interesting thing is when you go back over the last 100 years and you look at the CAPE ratio, the cyclically adjusted PE on the S&P, there's only 5 times in history, and we're there now where we've hit these levels. One was in 99 before the market cracked in 2000. You have to go forward to 07 before it cracked in 08. And then again in 2021 before we had that down 30% year in 22. And then again, at the end of 24, when we did see about a 20% pullback into Liberation Day before we V-shaped from there. So we just think valuation is why small caps look so attractive.
So, Amy, I want to get you in here. So Sandy says, listen, small caps are going to have their day in the sun. Amy, what do you see?
Yeah, I would say this is a key question for investors we talk to, because small caps, for traders, it's not necessarily just about fundamentals. It's about how they bake into factors. So when you think about small caps, we use IWM as a proxy, but it's this idea of when we're going to get the rotation from growth into value, or from value, from momentum, which had been outperforming. You're starting to see signs of that, but 2 major indicators I'd look at. One is how much call volume demand you see in IWM, which again is that proxy for small caps. And 2, if you see a sustained reversion in that rotation between small cap with IWM as the proxy and Qs as the growth factor.
Sandy, what would happen? There are some smart economists out there, smart strategists. I've heard them, listen, they don't think the Fed cuts this year. Economy's resilient, inflation sticky. What if Jay Powell sits on his hands? Play that out for me. What would that mean for small caps?
Yeah, that's going to be a tougher environment, and that's what we're in now. We've had the dollar fall 11% year to date, not good for small caps, and interest rates have been stubbornly high. So we need to see, kind of probably the job market fall apart a little bit, and we need to see rates come down for small caps to finally get the wind in their back. But again, we just need a rotation in sentiment from large cap growth to value or small cap, and I think that could also play out even if rates kind of stay flat.
Sandy, let's get to some names here because I always like to get your picks. Caesars, let's start there. Why is that one a buy? As you know, stock's been left for dead. You say, though, this is an opportunity.
Yeah, I mean, you're down 36% off the high. You're now trading at 7.5 times enterprise value to EBITDA. If you look at 2026 numbers, this is a 17% free cash flow yield. The stock is baking in a recession, and it is exposed to the consumer, which is not maybe a great spot to be. And they do have leverage. Every 100 basis points cut by the Fed, would be about 60 million in free cash flow added to Caesars. So I just think it's so cheap, and the worst is expected, that it's a nice time to be picking it up when everybody else hates it.
All right, from Caesars to a biotech. Walk me through this one. Ligand, that's ticker LGND.
Yeah, Ligand is really a chicken way to play the biotech industry. So they've got many, many shots on goal, as opposed to a typical biotech investment that can be a real binary outcome. Just on July 1st, to kind of give you an example, they just had helped put a merger together with Channel Therapeutics and Pelthos Therapeutics, and they invested about 18 million out of 50 million. This is a molluscum drug that impacts about 16.7 million people. And now you can actually take it at home instead of having to go to the doctor's office. They're going to get a 13% royalty on that. And then just one more, Merck bought Verona this morning, as y'all know, for $10 billion. They also have a mid-single-digit royalty on their COPD drug for progressive lung disease. So that's just two examples with their 90 different programs and 13 different commercial royalty streams right now. So we like that one a lot.
Final, I just want to squeeze this one in, Sandy. Option Care, ticker OPCH, which has had a nice bit of run here. I'm looking at up about 30% this year. You say there's some potential headwinds, but it's a buy, Sandy.
Yeah, it is. I think I could see this trading from about 13 times enterprise value to EBITDA to about 15 times. This is home therapy, treatments. And so I think a lot of people like these home infusions. It's much cheaper, about 50% cheaper than doing it in a hospital. It's much more comfortable for the consumer. And I don't think any of these things, as more and more people turn 65 and older, I don't think this is going away anytime soon. So we think it's got a good future.
Sandy, always appreciate your time and those stock picks. Thank you.
Thanks for having me. Appreciate it, Josh.
While we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.